Let's get more on the Asian markets, and we're joined today by Timothy Wong, who's the head of DBS and DBS Vickers Group Research in Singapore. Don't forget that DBS was one of the first few brokerages to advise clients to continue buying stocks even during the depths of April. And Tim joins us this morning from Singapore. A good Monday to you, Tim. So it seems like 2010, it's a different year, shall we say, because we're not going to see returns like we did in 2009, but you still remain positive at this point. So what exactly is the strategy to make money this year?
Well, I think we're looking at about a 15 return, 15 to 20% return on 2010. But actually, that kind of masks the volatility. So we see a strong first quarter, look for a pullback, quite a significant pullback, second, third quarter, and then markets sort of rallying again towards year end. Going to be a great trading year. I think investors need to be nimble to take advantage of this volatility.
Yeah, there is going to be a lot of volatility. So let me just ask you, how do you pick stocks? Because a lot of people say because of the volatility, it's really a stock picking environment. Stocks are no longer cheap either. When you look at valuations, it's pretty much just spread across the Asian Pac, looking pretty rich at this point. So how do you go in and pick up names that you think will have value still?
Yeah, that's a good point. Essentially, I think we're going to have to look at two groups of stocks. One would be stocks that have generally underperformed the markets. So, for example, we're looking in the industrial space, particularly some of the oil and gas plays that have not really moved up as much last year in the equipment and services field. The other would really be to look for companies with clear earnings catalysts, where earnings could exceed expectations.
Okay, well, I'm going to bring up one of these names then, Tim, because, Genting Malaysia obviously has a catalyst coming up, especially with its Genting Singapore division opening up that new mammoth gambling casino taking place in Singapore. What do you see for Genting Malaysia? Why is it worth buying in at this point?
Genting is interesting because if you look at what its subsidiary Genting Singapore has done, that stock has actually gone up a lot, and Genting Malaysia, which is the parent company, is kind of a cheaper way, I think, to get exposure to Genting Singapore. I mean, there has been some concern about cannibalization of the Malaysian operations, but generally we think that's fully in the price. And I think that this is a good example of sort of buying the parent to gain exposure into the subsidiary.
Okay, now this is one stock I don't understand that much. It's Singapore Airport Terminal Services. Interesting, because we just heard from Singapore Airlines this morning saying that it seems that their passenger numbers have actually dropped 4% over the December period. So why is Singapore Airport Terminal Services worthy of a buy at this point?
Yeah, well, first of all, I think that Singapore SATS is essentially a play on Singapore's increasing growth as a service hub for Asia. With the starting up of the IRs, visitor arrivals should increase significantly. So I think we're looking more at that structural growth angle. Short term, there will be fluctuations, and if anything, if the stock gets sold down, it's a great opportunity to position for medium to longer term growth in visitor arrivals into Singapore.
Okay, Timothy, thank you so much for your time this morning. Nice talking to you. That's Timothy Wong of DBS Vickers Securities.